Retail credit risk has a dark side. Sometimes unexpected economic problems like recession, job losses, or falling property prices can cause losses to rise much more than expected. When borrowers' income falls and collateral values drop, default rates increase. This is what we call the dark side of retail credit risk. There are several main causes behind this. First, many retail products are relatively new, so there is limited historical data to accurately predict risk. Second, sudden economic changes can increase risk factors very quickly, making borrowers behave differently than expected. Third, certain social and legal environments may unintentionally encourage defaults. Finally, weaknesses in semi-automated credit approval systems can lead to poor credit decisions and higher risk. To control this problem, regulations like the Consumer Financial Protection Act require lenders to properly evaluate a borrower's ability to repay before approving loans. This led to the concept of a qualified mortgage. A qualified mortgage assumes the borrower has the capacity to repay and limits the debt-to-income ratio to 45%. It also does not allow risky features like balloon payments, interest-only loans, loan terms longer than 30 years, negative amortization, or excessive upfront fees. The goal is to prevent unsafe lending practices. When evaluating a borrower's ability to repay, lenders check several important factors. These include credit history, income and assets, employment status, monthly mortgage payments, insurance and property tax payments, other property loans, total debt obligations, and the final debt-to-income ratio. Even though retail credit is generally considered diversified and requires relatively lower capital compared to corporate loans, banks must still measure risk carefully. They use three key measures: probability of default, which is the chance that a borrower will default; exposure at default, which is the total amount owed at the time of default; and loss given default, which is the percentage of loss after recoveries. These measures help banks manage and control retail credit risk effectively.